here's that midnight delineation, starting a new day. We rally up, and then we break down. So what's the model teach? Trading when? The New York session. Okay, so we're trading the New York session. In Forex, it's 7 o'clock in the morning to 10 o'clock in the morning, right there. Okay, so 10 o'clock in the morning and 7 o'clock. So we're looking for a setup that would be formed within that time frame. So the New York Killzone, it runs up into that, runs the highs, and we want to see a displacement to the downside. We get it right there. Okay, so now you have this area here, and then you would put your order in right there. What time is that? It's 10 o'clock. So you put your limit order in to sell short right at that price right there, or plus 1 pip, period. And your risk is going to be above this high. The imbalance is really stretched out. You can use that as your stop. If you're really concerned, you can put your stop above the swing high. But whenever you have a big range like that, my stop can place right there. So your stop would be here, and you're going to go short here. That's the minimum expectation using the 15-minute time frame. But we're going to split the 15-minute time frame down into 5-minute intervals. Okay, so we're going to look inside this range here and see if it's advantageous for us to go down into a 5-minute chart. And does it have a fair value gap in that? All right, so we're looking at the 5-minute chart now, and it's that shaded area here. So it's using this specific candle, or that low. And we're looking inside this range right here. Okay, so it's this decline we're looking at. Does it have fair value gap? Well, we have this small one right in here. See that? We have this stretched out one here. Yes. And then we have all this run in here where it has a small little fair value gap. So now think about what's been shown. On that 15-minute time frame, we have a minimum threshold of at least reaching into this low. Okay, remember I showed you on the 15-minute time frame that imbalance. So it needs to get up into that. Okay, so I'm answering the question I saw, or it really wasn't a question. It was someone trying to make a point that, was I showing something incorrectly by showing a higher time frame fair value gap? Because wouldn't the smaller time frame fair value gap form before the higher time frame? No, it never works like that. The higher time frame imbalances are going to be parent to the subordinate smaller time frames. Okay, the parent, okay, is this 15-minute time frame imbalance. So it needs to get above that. But when it does that, we have to look at the lower time frame below 15-minute time frame, which is the beginning stages of our fine-tuned entry of 5, 4, 3, 2, and 1 time frames. So here we have the 5-minute chart. We have an imbalance right here, and then we have that smaller one right in here, and all the way up to this price point here, we could factor that in, but it's not likely to get up there. So we can look at what? This level here, that is the minimum expectation. You can put a sell limit order there to go short, or you can fine tune this to rebalance all the way up to here, right there. In other words, it would look like this. This would be your imbalance on the 5-minute chart. And if it traded up into that right there, okay, in other words, you could use any specific price in this range here you can pick. But long story short, this would be your range you can work within, and it trades up into that secondary fair value gap. Now, some of you might say, well, what happens if I put a limit up here? Well, that would be obviously a stellar entry, but you don't necessarily need that, okay? Why I like this one is because if you look at the 15-minute time frame, it was like this. That was the range, okay? So if we go up in that range to the upper end of it, look over here. What do we have? All three of these candles here. 1, 2, 3. The order block begins with this candle's low. It's 1, 2, 3 candles making one consecutive bearish order block. So the logic is we ran up into this daily fair value gap. That's what this level is up here. This red line was those relative equal highs on the hourly chart. Remember that? And you're probably going to need to watch this video a few times because I've gone through a lot already. But I'm breaking down the market. And this run here is the run into that imbalance and above the relative equal highs. So this is the bearish order block. It's the consecutive run on this time frame, the 5-minute chart. It does not need to get up into this last up close candle before the down close, because that's what everybody says an order block is. It is not that. Notice it doesn't even get up to that, does it? Why? Because what I'm showing you here, what makes an order block valid? It has to have an imbalance. Without the imbalance, there is no order block. The order block is all 3 consecutive candles. The reason why this last up close candle is not even traded to is because the higher time frame parent imbalance, that 15-minute time frame, which is being shown here, that range of that low and that candle's high here, it stops there. So there's no necessity for it to trade up into that last candle. So if it trades up into this candle here, the bottom one, the last one of the 3 going up, that's enough for me, and take that over here, and then we have this imbalance. So in my mind, this imbalance is sufficient. We don't need this one, and you wouldn't expect that last up close candle to be traded to. So this is the ideal scenario that I think the mentorship on YouTube should be looking for. Now, as soon as you have this, this is when you settle in on, what are you met with? Another little fair value gap right above it. So what were the rules that I gave you when it has that in the chart? Think. It is going to be a likelihood that it could trade up in there, but your limit order to enter is down in here because it might not get up here. What am I trying to do? I'm trying to teach you how to avoid missing trades, because a lot of you are going to want to put an order up in here. And yes, it would have been filled on this instance, but many times you're going to have an order placed at a really overzealous price point that if you nail it, it's beautiful, but they don't happen a lot. It's fleeting. It happens once in a while. So we had a break in this low here. So there's an internal shift in market structure. It's bearish. We have the imbalance here that's been refined down into the 5-minute chart in concert with the bearish order block, the lowest down close candle. We've talked about why we're not looking at the last up close candle before the down move. So we're canceling all that misconception. And it runs up into the level with the rule I gave you. If we settle in on a fair value gap and it has a small one above it, expect that it might trade up there, so your risk has to incorporate that. So that's the reason why I'm telling you your stop loss could be here. So here's the framework, the setup. We have our market structure shift. We have disqualified all these upper candles here. The lower candle, that's where you're going to aim for. What's the order block that you trade for, Michael? What's the right order block? How do I pick the right order block? I just answered it. What is an order block? It's a change in the state of delivery. The algorithm changes its state of delivery. As soon as we get below this candle's open, the market starts delivering sell side. And then it breaks this swing low. So now we have changed gears internally. Any rally after that is just setting up another run to go lower. So in other words, this is a suspect rally. Okay. So this is an intermediate term high. Swing high, because it has the imbalance. It should not trade higher than that high. That's the reason why I'm telling you, you can put your stop loss there. See how the rules are coming together? I'm not complicating it. I'm literally telling you everything I've taught, and I'm putting it into the chart. Everything was said before it happened. And this setup here gives us a nice opportunity to get short. So you could be a seller here on a limit entry. So you place your limit order here, and you just walk away from it. You let it go. Now, what happens if it doesn't fill you by 11:30? Pull the order. It's it. Don't put it good till cancel. Just pull it, because you want to be entering on the day that it creates this. Because relative equal highs, if it doesn't drop off, it could come up at a time of day where you won't really want to be there, and it could fill you and then keep on running and take out the relative equal highs at a deeper pass and stop you out. So it's important to know why the kill zones are there. Kill zones are when you determine your entry and you place your orders and you walk away. You don't need to have your entry filled inside that kill zone window. Your order idea and your order placement needs to be considered at that time. If you can't derive a order placement for setup or trade entry by that time, you have nothing to do. And that's it. You've basically taken no risk on, and you have to wait till the next trading opportunity or trading day.